Hey all, welcome to ShareTreck. This is Raj here. We have Labor Day holiday tomorrow, and I was looking at the volatility in the market, and my thoughts were that earlier I would have been very panicked with these volatilities, and I'm feeling very chill and tranquil right now. I wanted to share with you my thoughts about volatility because we are a retail investor channel, and one of the reasons why I started this channel was not only to get more information from you guys and learn from you, but also to share my experience. After all, I've been investing for almost 3 decades now, and I'm going to share some of those lessons that I learned in this video. And if you have some interesting lessons for volatility, please mention that in the comment section. I will benefit from it, and the rest of our community will. So with that said, let's get started. Welcome back, friends. Imagine that you're in a small boat in the middle of a vast ocean. The sky is clear, the water is calm, and everything feels perfect. But suddenly clouds gather, the wind picks up, and before you know it, you are in the middle of a fierce storm. The waves crash against your boat, and it feels like you'll be swallowed whole by the sea. Panic sets in, and you're tempted to abandon ship. But deep down, you know that if you hold on and steer carefully, the storm will pass and you will find yourself back in calm waters. This scenario is a lot like what happens when the stock market experiences volatility. The storm can be terrifying, but if you stay the course, you will come out stronger on the other side. And while the storm is going on, just like the volatility right now, it may seem like forever that you are in this kind of a turbulence. So that's what I'm going to talk about today. Today, as I see there's a lot of volatility in the market. The second half of this month also promises to be very volatile. And then we have the elections. So in today's video, I want to address this situation, and I want to share my thoughts about the importance of keeping a long-term perspective while navigating the turbulent waters of market volatility. It's crucial to remember that your investment horizon, the length of time that you plan to hold your investments, can be your most powerful ally during these uncertain times, and especially for long-term investors. And how do I classify myself? I am part long-term investor and part short-term. I am an opportunistic investor at times. I have a small portion of my portfolio allocated for speculating, and then I have a reasonably bigger size of my portfolio which is allocated to really stable stocks which give dividend and which have capital appreciation. So that's how I define myself. So on my short-term speculative aspects, I feel a lot of heartburn, but in the longer term, I'm very comfortable. So let us understand market volatility. So what is volatility? Market volatility refers to the rapid and unpredictable changes in the prices of stocks and other financial assets. It's like those waves in our ocean. And sometimes they are gentle, and other times they are so powerful that they threaten to capsize your investment boat. And I remember my experience with Shopify. Earlier in Canada, when Shopify was new, and the share was very dynamic, and it had a lot of volatility. And I had a great time buying low and selling high. I made a lot of money in that, so much so that I put all the money back into it, and then Shopify fell and I lost all the money and I couldn't get back in again. So that was a very bitter experience of volatility, because sometimes when you're in sync with the volatility, you can make money. And in those days, I was not doing covered calls and all that. So it became even that much more difficult for me. But over the years, I have gained more experience. I'm going to show you this graphic out here. I'm going to talk around it for a minute. Now take a look at this chart to give you a clearer picture. I've created an approximation of historical data over the past few decades. And over the past few decades, the stock market has experienced significant ups and downs, yet the overall trend has been upward, as you can see in this graphic. Both the green line and the red line are moving upwards in the longer term. But in the first part, you are seeing that there is a whole lot of fluctuation. So you have growth on the one of the axes and time on the other axis. And as you can see, over time, which is, let's say, days and weeks, which is what a speculator or a short-term investor looks at, you have got a lot more volatility because the price is going up and then sharply going down and so on. So during that short period of time, a trading day can look like a very long period. 1 hour can look like 5 hours, and you end up making some decisions. And at the end of the day, you find that the share went down and then it came up and then recovered some much more. So those kind of disappointments happen because the volatility has this effect on our brains that it takes over and makes us take risky decisions, and we end up losing in most of the cases. And it can cause anxiety. That doesn't necessarily indicate a long-term problem, because if you look at the time in decades, you will see that it's a straight arrow upwards. But if you look at it in months and years, you will see that there are some 6 months period of going up, and then another 6 months period of going horizontal, and 5 months of going up, and then 2 months of going slightly above, and then sudden rapid raise, and so on and so forth. But it's not as jarring as we find in days and weeks. So that's the point that I want to make. So let me share a personal anecdote. I remember a time when I was just starting out in the stock market. I had invested in a few promising stocks, and for a while everything was going well. You can call it beginner's luck. But then out of nowhere, the market took a nosedive. I panicked and considered pulling out, thinking I had made a huge mistake. But instead, I took a step back, reminded myself of my long-term goals, and decided to hold on. In the end, the market recovered and my investments grew even stronger. This experience taught me the true nature of volatility, or so I thought. Volatility is temporary. That was a good lesson that I learned. But the long-term goals are not. The long-term goals will be achieved. However, I tried the same thing again with my holdings of Yellow Pages. I had been receiving steady dividends from Yellow Pages, and thought holding them as a price, as the price fell, and buying a little more would be beneficial, because after all, I'll get more dividends. And then the price will go back up again and my yields will be better. And I thought I was very smart. However, I was wrong. I forgot to check the fundamentals. The advent of Google search was killing Yellow Pages, and I lost all my investment in Yellow Pages, which was a sizable amount of investment because it was giving steady dividend. And I did a dollar cost averaging, assuming that I was smart and that I had learned my lessons from my earlier experience of holding on during volatility and coming back stronger. So the long-term perspective is good, but keep an eye on fundamentals and other factors. Nothing is good forever. You have to be always alert. Sometimes it's going to be fundamentals of the company. Sometimes it is geopolitics. There are various other things that can impact your stock. So never take anything for granted. And the role of investment horizon is very, very important in defining how jumpy you're going to be with volatility. Your investment horizon is the period you plan to hold your investments before needing to access your funds. This could be a few years for some or several decades for others. And the longer your horizon, the more time you have to ride out market fluctuations, and therefore more tranquil you will be. So let us look at long-term versus short-term investing. In short-term investing, it is like trying to navigate a storm without a map. You are more likely to get lost or even shipwrecked. But long-term investing is like having a sturdy ship with a reliable compass, and you may face storms, but you're better equipped to handle them, and you will eventually reach your destination much more comfortably without too much of fear. Let me give you a personal anecdote in this. A friend of mine invested in a retirement account back in the early 2000s, and despite several market crashes, they never touched their investments, keeping their eyes on the goal of retirement. Fast forward to today, and their patience has paid off. The value of their investment has grown significantly, far beyond what it would have been if they had panicked and sold during the downturns. Now let me give my own example. I'm going to show you my Indian portfolio. So here is my Indian portfolio. And as you can see, I have a lot of gains out here. Let me just give you an idea of what kind of gains I have here. Overall gains, if you look at overall gains, that is this Colgate, everybody knows that company, a gain of 227.25%. And then one of my biggest gains is in Indian hotels, 330.42. This is the company that owns the Taj group of hotels. It's all 5-star hotels and other chains. And a big engineering conglomerate, Larsen & Toubro, 445.94% gain. And then of course Wipro, you guys have heard of that company, 375.20%. So it's all huge. And the reason that it is huge is because I do not sell anything in this portfolio, and I very rarely buy. and only on conviction. And this portfolio was created more than 30 years ago before I left India. And as you can see, this has grown a lot. Now let me show you my mutual fund portfolio. And this happens to be my mutual fund portfolio. And as you can see in this portfolio, we have got tremendous gains. The very first set of mutual funds that I bought was the HDFC Balanced Advantage. I bought it 30 years ago. It has grown 2,116%. And the other one I bought was the Capital Builder. It has grown 2,129%. And then, of course, the others have also grown significantly. And all these quant and other things are all new investments. They are reinvestment of annuities. So they are also multiplying, but they are all in SIP, which is systematic investment plan. So the gains do not seem to be that much because they are dollar cost averaging on a monthly basis. But still, there is a lot of gains out here. So this is how the stocks multiply when you have a long-term portfolio and a long-term perspective. And as you saw, both stocks and mutual funds have multiplied nicely. That takes me to the benefits of compounding that comes from long-term investing. And the benefits of long-term investing, which is compound interest, was explained to me by my dad when I was very young. And he encouraged me to invest for my retirement. At that time, I didn't listen to him. And for a long period of time, I didn't start investing in retirement. I started investing for retirement only in my late 30s and very close to early 40s. In that time frame, I started investing. If I had listened to him, it would have been best. One of the greatest benefits of long-term investing is compound interest. This is when your investments start earning returns, and then those returns begin to earn returns as well. And over time, this compounding effect can lead to exponential growth, far outpacing the impact of short-term market dips. And in case of the Indian portfolio that I showed in the stock section, right, I have not bought any more stocks, but some of the companies spun off subsidiaries and bought IPOs, and those shares were issued to me. That got accumulated there. So I had a new company in my portfolio. And some of those companies give what is called as bonus shares in India, which means if I have 1,000 shares, they could give me a 1:1 bonus. Reliance Industries is doing it right now. I have that in my portfolio. They are giving me a 1:1 bonus, which means for every share I have, I'll get another share without any payment. I'll just get the share in my name. And over a period of time, that share again appreciates value, and I get more dividends because now I have twice the number of shares. So those things have happened for most of the stocks in that long-term portfolio, and it has compounded. So it kind of grows very fast. And once you start seeing the growth, turbo growth, then that itself motivates you not to touch the portfolio and hold on. And you can just go through volatility feeling very tranquil and without any hesitation. And even when the market is really bad, when the stock market crashes or anything, my portfolio is still green. So I don't worry about it when it comes to the Indian portfolio. I'm attempting to do the same thing with my North American portfolio. And I have some really strong holdings like Costco, Walmart, Exxon, and Berkshire. These are all strongly in the positive, and I'm holding them for the longer term. My shorter term ones are where I'm dabbling around with FNGU, NVIDIA, and CRISPR and those kind of things. Now let us talk about risk reduction. A longer investment horizon also reduces risk, and the market may be volatile in the short term, but historically it has always trended upwards, as you saw in that chart. And by staying invested, you give your assets the time to recover and grow, rather than locking in losses by selling during a downturn and buying it when the price goes up. So I showed you that graphic earlier. That could have illustrated the point very nicely. I'm going to put it up here again. Notice that the long-term price chart has a very smooth curve, which is almost straight, whereas the medium term has a little bit of jaggedness, but not like the sharp jaggedness we can see on the very short term, which is days and weeks. So that is the magic of being long-term, and you get a long-term perspective. You'll not worry about volatility at all. Again, let me share the anecdote of a friend and my own personal anecdote. And another friend of mine started investing in their 20s, consistently adding to their portfolio even when the market was down. Over the years, they saw the power of compounding firsthand. And in fact, that's what inspired me later in my life to replicate the same thing. Now in their 80s, their portfolio is a testament to the value of time and patience. So as I showed in my Indian portfolio, I do dollar cost average on some of those blue chip counters, And those things happen very, very rarely. And that too on very high conviction situations. Like I bought the Indian hotels during the COVID downturn. I bought extra Indian hotels shares. And I did that because the Taj hotels in India is the gold standard for 5-star hospitality, and I was 100% sure that the company will come up again. It's part of the Tata Group. So without hesitation, I bought it, and at that time I got it for $120 or something like that, 120 rupees or something like that, and now it's in the 650 rupees price range. So it has multiplied significantly. And I also get bonus shares, which again do the compounding effect. And on top of that, I have annuities which pay once in every year, and I pump them into the mutual funds in the systematic investment plan to buy new mutual funds. And those are the ones that you saw at the bottom of the portfolio. They were all quant mutual funds. So that does my future compounding, because the annuity is a one-time payment that you make to get a fixed amount every year regardless of inflation. So because the annuity is not linked to inflation, my idea is to invest every year the annuity that comes into mutual funds, so that it can take care of the inflation issue. So that's the idea that I have followed out there. And this all helps me to overcome fear and uncertainty, addressing the volatility. It's natural to feel scared when the market is volatile. The fear of losing money can be overwhelming, leading many to make hasty decisions. But remember, fear is a reaction, calm is a decision. And to make the decision to stay calm is very, very difficult until you understand the correlation between your investment horizon and volatility and your fears. So there is a very direct correlation between that. So there are a few strategies for managing fear. The first is to spread your investment across different asset classes to reduce risk. I keep on mentioning that in the comment section to some people. And this way, even if one part of your portfolio takes a hit, others may hold steady or even grow. So right now, I'm taking a lot of risk with FNGU and NVIDIA and CRISPR. But at the same time, I have got steady investments in Berkshire Hathaway, Walmart, Costco, and Exxon. Those are holding everything steady, and I have a risky portfolio on the other side. Next, we look at the other strategy, that is dollar cost averaging. Of course, I made a mistake dollar cost averaging in Yellow Pages, as I mentioned in the anecdote. But you can dollar cost average on stocks which are really good blue chips, very good fundamentals, but there is heavy market volatility and no fault of that company, the share price falls, then you can definitely buy those shares when there is a sell-off. And dollar cost average, it brings down your average cost of holdings, and thereby it reduces your risk, because when the market bounces back, this time your average cost per share is much less compared to where the market will be. And believe me, the market generally bounces back after a period of time. It can't stay down forever and it can't stay up forever. That is the nature of the market. So dollar cost averaging helps, but look at the fundamentals. Dollar cost averaging on the wrong stocks can have a opposite effect, and dollar cost averaging on the right stocks can be a good thing. And then you need to have a certain amount of emotional intelligence. It's essential to keep your emotions in check while investing. Markets fluctuate, and that's a fact. What matters is how you respond. Keep a clear head, stay informed, and stick to your long-term plan. Now here, I don't have a stock market analogy that comes to my mind to immediately explain to you. But guys, remember, I'm a real estate broker in Canada, right? And I'm also a real estate investor out here, and I have investment properties. I have condos that I give out on rent. And there are times when I buy a brand new condo and I hand over the key to the first tenant, where everything, the built-in appliances, everything is in plastic wrap. And what I tell myself, and also to my clients who buy condos from me for investment, is when you're buying a condo for investment, don't have emotional attachment with the property. It's an asset and you're buying it for a particular purpose. Hand over the key, do your tenant selection properly, and manage your tenant relationship properly. Make sure that you receive your rents in time. Periodically go and inspect the property to make sure there is no damages. And when the time comes, do not hesitate to sell the property and book your profits. That's what I say. And for those people who get emotionally attached to the property, when the builder gives you the key for a brand new condo, if you say, oh God, I don't feel like giving this out on rent to a new tenant, I would rather keep this, I would rather live in it, then you are not going to be a real estate investor, because That is absolutely the wrong kind of mentality to have if you want to be a real estate investor who is renting out properties. So that's the example that comes to mind when I talk about not being emotionally attached to your stocks or to your assets. So that's where the emotional intelligence comes in. And whenever you learn a lesson in the market while dealing in a particular stock, write it down somewhere and then put it on a flip chart and keep it in front of you. It will come in handy next time you're trying to make a decision, because we forget all these experiences unless we write it down. And then in conclusion, I will say that to navigate market volatility, it's crucial to maintain a long-term perspective, understand that volatility is a nature of the market, it's a natural part of investing, and that your investment horizon can help you weather these storms. Remember the benefits of long-term investing, such as compounding interest and risk reduction, and use these strategies like diversification and dollar cost averaging to manage fear and uncertainty. And at the same time, I'll tell you guys, I see many people on the comments asking me, Raj, can I buy this particular stock for this particular price? Raj, can I sell this particular share? Raj, is this company totally dead? Is there any hope for the company? And the thing that comes to mind to me is that as a good investor, you should not be asking anybody for these kind of definitive answers. You should be looking for fundamentals. You should be looking for trends. You should be looking for market sentiments. You should be looking at technicals. And then you should be looking at your own portfolio and deciding what part of your portfolio should be long-term, what part should be short-term, are you diversified enough? And then if you make a decision, you'll be able to survive the volatility, you'll be able to ride the volatility and still stay calm. But if you don't do that, then you're literally gambling in the market. It's like betting on a horse that you don't know about and cheering for it to win. And if it doesn't win, then you go back and bet on some other horse. It's just like that. And I also see there are people who come up with a new stock every day and say it has gone up 25%, it has gone up 10%. But one of the hard lessons that I learned in the market is that you have to keep a narrow focus. You have to have a focus on a certain number of stocks that you can follow on a regular basis, and some stocks where you are intimately in tune with the movement of those stocks. You know those stocks intimately, and then you would be able to make really good decisions. And if you go all over the place and start chasing the latest trend and the latest fad in the market, then the chances of you making consistent profit is very, very less. So I would urge that you invest in industries that you understand. You invest in products that you use yourself and understand as a customer, so that you can get a feel for those companies and their products and their market and their profitability. And that is a much better information to you from the point of view of market intelligence. And that will help you during volatility, because you understand the product, you understand the quality of the company, you understand the pricing power of the company and its appeal to its customers. And as a result, you will be able to ride the volatility much better. You would know when to bail out and when to buy in. And I would say before I end this video that the next time the market takes a dip, don't panic. It's doing that right now. Instead, take a deep breath, revisit your investment goals, and stay through the course. Your future self will thank you. And I'll end this with a very inspiring quote from Warren Buffett. He said, "The stock market is designed to transfer money from the active to the patient. Be patient, stay strong, and keep your eyes on the horizon. Stay calm and carry on." With that, my friends, I would like to end this video. I hope you liked this segment. I would like to hear your wisdom about how to handle volatility. Please put that in the comment section. I'll benefit from it, and our entire ShareTreck community will benefit from it. Thanks and have a great day. Enjoy the long Labor Day weekend. Bye for now.